Hello, traders. Talking about Lyft today. Somebody asked me about this. And caveat, I am long Uber. And also caveat, I don't think they're even competitors. Uber wants to be one thing, Lyft wants to be another thing. They do cross paths in one of the things that Uber wants to do. So I think of Uber as, by the way, my position there is in stock and for the super long term. Think of it as an Amazon wannabe. If they continue doing what they're doing now, I think they're headed that way, which means they want to own multiple streams of income. Whereas Lyft, they decided to be local and decided to be strictly people movers for now. So into Lyft, somebody asked me to give an opinion. I think they had a specific question, but it doesn't matter. So I'm going to just review the stock the way I would any stock. So this is Lyft. And before I forget, at the end, there'll be subscribe to this channel. It's free on YouTube, so hit it. Also down below in the description, you can click read more. There'll be a link to join in the chat, which is open all day, every day. We do this all day. It's really cool. Free to try. Okay, so fundamentally, I'm not a good judge, but we can take a peek. I can't imagine it's cheap, but the data will tell us. It sells at about 6.5 times sales. It still loses money, which is fine, so there's no PE, so to speak. But 6.5 times sales is not crazy expensive. It's twice as much as Amazon-ish. As we were speaking, the markets are open and the small caps just broke out a little bit intraday. So in this case, I don't want to judge it based on value. It's a growth stock. It's a long-term stock, so they lose money now, big deal. As long as they're growing, then it's okay. Amazon did it for a decade. So here we are. On the chart, it's a daily chart. It's a relatively new issue, so we don't have a year's worth of data, just under. But there's a lot to be said right from here without doing anything. So as a chart, I can see that clearly it's off the lows and higher lows, nice trend, ascending trend of higher lows. And you can say knocking at a prior pivot zone. So if I look at it, this $51-ish, plus or minus, was a big fail point right here. And if you look at it, it's eyeball half the distance of this. And it was the bottom-ish of the prior debacle. So it came out of the box with the IPO, straight downhill. Right? Everybody hated them. The unicorns, oh my gosh. You couldn't own it. And then they found a bottom somewhere near 50, 52, 51, 49. Rallied big. Gave it all back up. They tried to hold it, and when they couldn't, they overshot to the lower. And here they hated them even more than before. Here the hate was towards anybody that doesn't make money. And this is crazy because every startup doesn't make money. You can't start a successful company without losing money in the beginning. Very few startups hit the ground and burst onto the scene as profitable. So that was an overshoot. So they came back to it. Failed the first time attempt at taking out that nice line, and now they're taking their time building another wave at it. So this is how they break out. They call it cup and handle, inverse head and shoulders. It's just the fact that the way they break into resistance. So we decided this zone was a floor that they lost. They came back to it, so it was support, and then it became resistance right here. So again, resistance throughout this zone here. And here they are. They're trying at the third time. If they can breach it, come back down and use it as floor, then they can continue the recovery and overshoot higher. So this then becomes cup and handle or inverse head and shoulders if you draw it here. It's basically attacking a neckline and overshooting. And then they go higher. How much higher? Well, the technicians will tell you it should be as deep as the deepest of the bowls. But to me, I don't argue with that, but what I say that there'll be stopover points, and this would be one of them right here. I built it big because it starts anywhere at 56 or higher, and if I were to draw a line, I'll probably eyeball it here, right there. So let's call it 63, and I can get you a value that I eyeball. And then I'll say that, okay, they can get to 68 with several lines of resistance, but 68 would be definitely, if they get there, that would be my book point. If I'm long from down here, from this breakout, I'd book up here. I'd lighten up all the way because they're going to do this kind of thing. They're not going to go straight up. So specific values, and I think that there'll be a lot of resistance at 55, and there'll be a lot of resistance at 58 and change. Some resistance is 61 and let's call it 62, and the big zone is around 67. So these are lines that they would cross on the way up. But first step is to break out. So are they breaking out? I don't know. There's earnings. The earnings are coming, and they're a complete crapshoot. The reaction to the earnings, the short-term reaction to the earnings, is binary. What does that mean, binary? It's zeros and ones, on or off, and nobody knows why. If you tell the CEO or the CFO or somebody at the company, you know your earnings, you know the P&L that's going to print tomorrow, you know what you're going to say, do you think you know how the market is going to react to it? Their guess wouldn't be any better than your guess. So Amazon delivered almost exact numbers as Facebook. Completely opposite reactions. Facebook got shellacked, down 10%. Amazon was up 10% or whatever, 8 or 9%. Maybe even more, actually. So we don't know. It's a guessing game, short term. So the charts do give us some clues, but with the caveat that the earnings short-term reaction may muff them up. So I drew two lines earlier because I was discussing it. So if it falls into this line, it's a better buying opportunity than above. This is a short-term point of attention. So it's a from the volume perspective, volume profile perspective, the mostly traded spot is somewhere around here. That orange line is the most traded spot. So buyers and sellers love to be active around it for this period of time, which is since last middle of December on. So clearly it's sticky. On the way down, it provides support. On the way up, it's going to be resistance. So here, it should be support. It's not a hard line in the sand. If I were to draw a hard line in the sand, it would be these peaks down here, these tails. So 46 and change, let's call it 46. That's why I drew the line here. So if I was long and it's falling, I would probably put my stop at 46. Depends on my personal preference, of course. Somebody that doesn't mind, maybe they pick this tail right there. Which would make sense because that's a ledge of sorts. So the whole zone is supportive on the way down. Now the company could come out and say something like, we're going out of business, and it'll go straight down to 42 and change, but I'm just saying normal reaction, they should find support here. How much of a percentage is that? 4 or 5%. You can look at the options and guess what the market is pricing in, plus or minus. I haven't done that. So I don't have any trades on Lyft. I'm just helping out a friend. So where do I chase it? If I'm not long it, I don't get excited until they show me they can beat their last failing point, which is this one, 51. So there we go, back to that 51. So it's a zone, like we just looked at it on the daily. So if I go long at 51, I would put a short stop below it where I don't want them to lose the neckline they just took out. This is a neckline they just took out. So 49 would be, it's like, you know what? You can't take out 41. I'm out of 49. 51, I'm out of 49. So like this, what is this? So if I were to draw a line, I would draw it here. How many times have I said that? Actually, I'm not going to draw a line. So this poke right here is important, 49.5 and 49.3. And these three right there. 49.875. So 49.5 is also important. On the way up, it's going to be resistance. So let me drill down. This was 2-hour charts. This is 15-minute charts. So you can see there's still support here on the 15 minutes. So consolidation zone down here. These two candles are important to me. This was a failed, and then they took it out, and then failed again. Why did they fail it? That's not good. And then this one would be important for the opposite reason. It should be support, but if it fails from being support, and this one down here. So this is the logic I follow. And it all depends on the time frame. If I'm long for the long term, then why am I looking at it now? If I took a thesis that, hey, Lyft down the line is going to be great, then I shouldn't worry about it. I'll read what they say and decide if my thesis is broken, and then I'll decide to manage my stock. But if I'm trading it and swing trading it for at least 2-3 months or a week or 2 weeks or a day, I should pay attention to the chart because there's a lot to be said in it. And this applies to anything. Okay, so Tesla. uh, I don't remember seeing a mega cap ever acting like what Tesla did this week. It's just insanity. First of all, I don't like the car for me. It's not for me. I don't deny how pretty it is. I don't deny what they've done. I've been a skeptic for a long time, but once it broke 360, I was like, you can't be short this. It's going to 400 plus. I said, 400? I was like, yeah, so you can't be shorted. I shorted it yesterday based on how it acted. I don't mind it being up 40%, but 40% in 2 days, the way it got these two candles, this is daily, was weird. So, and then with it, so you can't really trade anything based on the daily candle here. You can make an assumption that the volume was accelerating. So it's probably short covering, forced short covering. So what does that mean? When somebody shorts a stock, they borrow it and they short it. Let's say somebody borrowed it down here at 400 and shorted it. Well, now there's $560 upside down at the worst case scenario. So if they don't have a bank account big enough to cover it, then they wake up to the broker said, you've hit your limit. We've covered your position without asking you, which means they bought on their behalf. And then guess what? Now you have 3 days to bring me the money I spent to buy that stock up there. So it's a huge punch to somebody who's short. So that's why in the morning you see these buying big candles. So I bought a put spread 2 days ago, and yesterday it went up 20%, the stock, and my put spread went up in value, which never happens. My put spread should have died, and it went up in value because the nervousness of the stock, the implied volatility. So needless to say, short term, the stock was in an insane mode, ludicrous mode, as they say. I heard somebody make the pun on that. So then I shared an opinion when it was here that, okay, Tesla might do this today. Before the market opened, the chart said, okay, they might fill the gap, so there's also information there. So ignoring charts is really giving the advantage to your opponent. Who's the opponent? The other side of your trade. If you buy a stock, if you short a stock, if you buy a call, you sell a call, there's another person that thinks the exact opposite of you, and you're assuming you're smarter than them. But what if they use charts and they have a whole team behind them telling levels and watching videos like this and deciding, okay, well, I've got tools, I can use them. And you come into the trade not having the same tools, so you're at a disadvantage. So you owe it to yourself to learn this stuff. If you want to learn, hit me up. We can work on that. So the information is there. Midday, I posted an update on, okay, if this happens, they could bump up, try to attack 800, maybe 840, but then they're going to fail. And if they fail, they're going to hit the 700 mark or so, or maybe even fill this gap down here, and they're on their way to do that. So I'm still short Tesla via the small bet. I'm not going to break the piggy bank, but it'll be a nice win. Just because I made money even when price went against me, so why would I want to close it right now? I have no incentive. But the only reason I made the bet is because of a set of tools that I used. One of which is an important tool is a chart. So you owe it to yourself. So in the case of Lyft, the charts tell us, to answer the question, it's at a point where it needs to make a decision. Okay, break out of this roof that has been established since last August, and the management has a stage in a few days to give people a push. That's the point. Between now and then, do I take a big position? I can't. If I love it, I would probably sell puts in it at the low, collect the premium, and hope it gets sold off. This way, I'll be long at a 10%, 15% discount. That's one way of doing it. How does that work out? I sell a put, that opens a position. No money goes out of my account. Money goes into my account. It's not mine yet. If they report and the stock rallies, that money is mine. If they report and the stock falls, I start losing paper money, meaning my position will start looking red. But if I sold it to own the shares, I don't care. All I want is to own the shares at a lower price. And if it falls through my level that I sold, I own those shares at the lower level and I keep the money. So I have a buffer on top of a buffer. That's the way I would trade it. I wouldn't buy the shares and hope it rallies. And if I really want to own them, I would buy half or a quarter and then add to them. This is not genius. Everybody does that. So leave some room to manage. I don't have enough information to know that, okay, I am so confident that this will happen. All right, Nick signing out.